We had another red week in the S&P 500, pretty much red right across the board, but the industry that got impacted the hardest, as we can see, drug manufacturers, healthcare, and big pharma right across the board. Now, ultimately, the reason for this comes as Donald Trump, the president-elect, picks vaccine skeptic RFK, and he ultimately wants him to lead as Health and Human Services Secretary. Now, as we can see, pretty much right across the board, companies did fall. It wasn't just Pfizer that we will speak about today. We have Moderna, we have Novavax, and we have biotech GSK, as well as what we just showed at the beginning of the episode. Now, one person who doesn't believe this will be an issue is CNBC's Jim Cramer, and he ultimately says that this appointment in the long term won't tank junk food as well as the drug industries. One thing to bear in mind though, investors over the more recent period have profited from doing the exact opposite of what Jim Cramer has been saying. Something to bear in mind, but the ultimate aim of today's episode is, should we consider adding Pfizer around the $24 mark? This is now trading at its 52-week low, and the one thing that makes this incredibly attractive to consider is the fact the forward yield right now is coming towards the 7% point, currently around 6.8. Now, we have both seeking alpha as Wall Street giving this a buy. We do know that Quant gives this a hold, but bear in mind 3.45 isn't far off the 3.5 that in turn would make this a buy, so they are sitting on the fence. And we can also see a relatively low forward P at 8.5, one we will compare to the overall sector. Now, yes, it is down around 18% over the last year. As we can see, just over the last 5 days, down 7% on the news we just discussed. And if you are a long-term shareholder, you would be down 15%. So if you invested in 2014, you would essentially have less money than your initial investment right now in 2024. Something to bear in mind. Yes, if you reinvested, you would be up, but still very poor performance. And we can see ultimately the COVID peak for this company. We're talking now 3 years ago at around $60, right now trading for even less than half that amount. So let's jump into this deep dive. Now, we'll refresh you in terms of how their earnings was. We can see it was actually pretty strong. They topped their earnings estimates. They also increased their full year guidance, something that we will run through as well from their latest investor presentation. And they are also looking at cutting some costs to help with their margins. So in terms of their actual numbers, we can see EPS 106, absolutely stronger than the 62 cents the market had initially anticipated. 17.7 billion, again, also beating on that top line from the 14.95. And as we can see, they've raised their EPS target to 275 to 295 from an initial 245 to 265. And they've done the same in terms of their revenue, 61 to 64 versus the 59.5 to 62.5 they had expected when they did mention their guidance. The other thing that we do quite like is that their third quarter, so what they've just released, their bottom line is now a 4.47 billion profit. The same quarter last year, well look, they reported a loss of 2.38 billion. So very, very good performance. Their top line is ultimately up around 31% from the same quarter last year. Now, we'll have a quick reflection in terms of their own investor presentation, and what we can see, they are very proud of the fact that they impacted around 271 million patients, and we can see, as mentioned, their top line up 32%. If you do remove COVID products, still up double digits at that 14% point. In terms of their actual numbers, well, their revenue not only is up, but their cost of sales is down. That will impact their margins, meaning that it will increase, showing us some signs of operating efficiency. And they're also earnings per share, as we mentioned, significantly better than what the market expected. So lots of positive signs that this company is moving in the right direction, something you do want to see. And also maybe you could argue the market has overreacted. The earnings has been very strong, so ultimately the share price should be going up. And maybe it is thinking that with RFK coming into power, it will affect this company. But as we will get to, there is a sufficient margin of safety. In terms of looking at their capital allocation, now just a quick refresher, they've returned a lot of money to shareholders through essentially increasing their dividend, and that yield, as we said, near the 7% point. They're paying back a lot of debt. We love to see this. In essence, delevering their balance sheet. Again, we'll have a quick look at that. And they're plowing in a lot of money into their internal research and development. Remember, not too long ago, they did have that acquisition of CGen as well. So not just through essentially R&D, but also through acquisitions. One thing though to flag, share repurchase, there isn't anything that they do have planned in the pipeline for the full year 2024. And for those that just want to see in a different format, the essential raise that they have done to their revenue, as well as that of the earnings per share. So it is moving in the right direction. We do like to see this from Pfizer. And when we look at moving forwards, we do have to flag that out of the next 4 quarters, only the next one, they actually expect growth to the EPS year on year. So 3 of the 4 negative growth. However, having said that, historical forecasting accuracy does look very, very good, 100% track record, but ultimately over the next full year, they're expecting the earnings per share to come down very slightly, which in turn will increase that forward P again very slightly to 8.54. So let's take a look at their underlying metrics. Based on the drop that they have seen, we're going to see some signs of severe undervaluation today. Starting off with their dividend safety, it sits at 75, indicating the safety, no worries there. Severe undervaluation on dividend yield theory that we'll run through, again on this valuation model as well. But as we've previously mentioned, disappointing for the growth at 2.4%, below the inflation target that we have of 4%. However, December 2023 was when they last increased it. This December, so next month, we are expecting a likewise increase. In terms of the dividend safety score, it was just reaffirmed a few days ago that ultimately their dividend does look to be safe and their dividend cut is unlikely. Now, in terms of the last recession, the 07-09 Great Recession, in fact, Pfizer did cut the dividend. They had above average growth, negative 6.1%. The S&P itself was negative 12, and they marginally outperformed negative 45, the S&P negative 55. In terms of dividend growth, we've already mentioned disappointed, although the next few weeks we are expecting a raise, and we can see over both the last 5 and the last 20 years, they've at a bare minimum been increasing it in line with inflation, which is very good to note. Remember, you are getting now a yield near the 7 percentage point, and we can in fact see they've been increasing those dividends for the last 13 years consecutively. So let's look at the 5-year average P ratio to understand where it sits in the current time. Now the blue tunnel essentially indicates the fair price, the expected value. We see it right now for the first time over the last 12 months, dipping completely out of that. That is a severe undervaluation signal. But remember, we're not looking at any of these models in isolation. We will conclude when we run it through our own valuation towards the end. Dividend yield theory, now for those that are new, it states a company is undervalued when the current yield sits above the 5-year average. Massive undervaluation, not only above the 5-year of 4.08, but also the highest yield it has offered over the last 5 years. And we also see the forward P right now at the 9.8 is lower than the 5-year average, another undervaluation signal. And to continue sounding like a broken record, we get another signal here as a healthcare sector does trade much higher at 16.1. Now do remember, this company is trading at a discount. You could argue, in fact, companies like Pfizer with their metrics should be trading below the sector. But as always, we will run through a comparison and get to whether or not we agree. Now, typically on this channel, we focus your attention to the free cash flow over the earnings, which is susceptible to manipulation by management through accounting. Below 60% is what we want to see. Reason why we use this target gives us faith management can offer attractive increases. Now, this is a red flag indicator, 193%, something you don't see in 2023. Ultimately meaning management paid out more in dividends than they generated in free cash flow. Nice to report, it is expected to come crashing down in a good way to 66% over the next 12 months. So I would like to see at a bare minimum next month a 4% increase just to maintain that inflationary rise. Now, free cash flow per share, consistent increases over the longer term. Remember though, what type of company this is. It isn't a tech company to expect massive increases. Pretty much flat up until 2020. Then we had COVID where it doubled, or in fact did more than double. Then it recently came down very sharply. Now over the next 12 months, we are expecting an increase. Remember, they are putting a lot of that COVID money into R&D, as well as into fact those acquisitions that we did mention earlier and some others. Now, in terms of sales growth, no surprise, especially for those that do know this company. As we said, very minimal growth up until 2020. We had COVID, 2 great years of double-digit increases to their top line. Then that post-COVID drop, negative 42%, and that is well reflected when we do look at it from a numerical format. In fact, we can see the top line doubled from 2014 to 2022 before decreasing sharply into 2023. Now, shares outstanding, we love companies that do share buybacks, returning excess cash to investor pockets. They've done this, although very inconsistently and very marginally. In fact, also understand from that latest investor presentation that we just saw, this isn't something they have planned in 2024. ROIC 10% or more, give us faith, management are able to effectively allocate their capital. Looking very good up until 2023. Good thing to note though, on a trailing 12 month, this is expected to rise to 7%. So we hope for the full year around the 10% point that we like at the very bare minimum. Then we move on to the operating margin, where we want to see two things here: above the minimum 12%, but also operating efficiency with margins increasing. Not something we see, very inconsistent, large drop into 2023. Positive to note though, a nice increase on the trailing 12 month to 19%, and the same to be said for the free cash flow, pretty much mirroring that examined format, down in 2023 and a nice increase to 14% on the trailing month. Now, in terms of the net debt to EBITDA, we want to see below 3. Remember, EBITDA referencing the earnings before interest, tax, depreciation, amortization, and the numbers you see below are the number of years it would take Pfizer to pay off all of their debt net of cash on hand, and this correlates to dividend safety, balance sheet strength, very high for the first time over 3 in 2023 at 3.75. Good to see the drop on the trailing 12 month, good to see the expectation it's coming down. And as we saw, they are wanting to continue to pay off debt to delever their balance sheet. So this is a good sign, something we really do like from the management team. Now, we also want to let you know we have released our latest free weekly article. We drop one every single Monday morning to your inbox, where we talk about severely undervalued stocks that deserve your attention, and as well as what's gone on in the market over the last few days. So click below, sign up, and you can read straight away, where you'll also be able to gain access to 40 undervalued stocks for the month of November. We won't do each one, a lot of information, the upside that Wall Street themselves see over the next year, and you can in fact grab a spreadsheet running through 22 undervalued dividend stocks with the most upside that Wall Street believe is in the S&P right now. So click below, sign up, and you can start reading straight away. We then move on to insider ownership, very low at 0.06%. In fact, no insider selling over the last year, just one insider buying over the same time frame of around 107,000. Now, in fact, the more recent quarter of Q4, we see 28,000 worth of buying, and Q3, no movement, Q2, no movement, Q1 the same, and in Q4, a little bit more buying. So very trivial amount. Nonetheless, we will still show you it was the director who bought around 1,000 shares on the 30th of October. Now, we do like to see insider buying. We believe it is a bullish signal. Management only buy because they believe the share price will go up. But bear in mind, you could argue this is a fairly small amount. Nonetheless, for full transparency, all the information is there, so you can include it, or if you don't want to, in your investment thesis. Then we have institutional ownership, 68%, around 8 billion worth of sales over the last year. During the same time frame, marginally more buying by the institutions. When we do take a look though, in Q3, significantly, in fact, around 4 times as much buying by institutions. So they are very bullish on Pfizer based on this data. But as always, do your own due diligence. Never copy what insiders of the institutions do. Now, in terms of their top line revenue, we've already covered their growth, in fact, how inconsistent it was, how COVID really helped. What we want to identify in this part, what does the bottom line net income tell us? Does it follow a similar pattern? Is it increasing? Is it decreasing? And when we take a look, again, we get a lot of that inconsistency on a year-on-year basis. In fact, 9 billion in 2014, 2.1 in the latest annual accounts. Something, again, when we look at margin of safety as part of our analysis for the valuation, do consider all of this information. Then we look at the health, total cash versus total debt. Cash, in fact, has been decreasing over the last 10 years, around 36 billion in 2014, and then we can see right now around 10 billion. Now, one number in isolation won't tell us anything, so we do always like to compare it to total debt numerically and directionally, and one of the reasons why their cash balance did in fact decrease, As we said, they did have to pay a large sum for the Seagen acquisition. In terms of total debt, we do note the inconsistencies with a fairly large increase just over the last full year. In fact, total debt going from 37 billion in 2014 to 68 in the latest quarter. So cash is significantly lower, and as we saw, the net debt to EBITDA sits just below 3. Again, lots of things that we just want to flag for your own overall investment thesis. Then we get to the valuation where they get an A. Now in terms of why that is, right now the P is trading at 8.5 forward looking, sector around 20.2. So if you're buying Pfizer tomorrow or whenever the market opens, you are right now getting a 58% discount. Is it warranted? Again, is it having poor metrics in relation to the overall sector, growth, profitability? We will cover that, but regardless of what valuation metric you use, Pfizer, in comparison to the sector, is trading at a massive discount. Now, growth grade a D-, so we can see why there is some of that discount. Year on year, negative 14%, sector positive 7%, forward looking, the same to be said, sector positive 8%. And when we do take a look at the EPS over the next 3 to 5 years, it's expected to grow at 5%, with the sector overall at 10.96. So we can start to understand that. However, when we get to the profitability, it does look very good. Gross margin 70%, sector at 58%. Bottom line net income 7.2%, sector in fact losing money negative 4%, and that is shown here. Look how good this is for Pfizer. A+ on cash from operations, 11.3 billion over the last 12 months. Sector median losing money negative 15 million. So quick recap this part of the analysis. We have a double buy seeking alpha on Wall Street. Quant, I would argue they're on the fence between a hold and a buy. A on valuation, D- on growth, with an A+ on profitability. Now, two final things before we jump into the valuation. First one, comparing against others in the sector. We have Sanofi, Bristol Myers Squibb, AstraZeneca, Zoetis, Novartis, all in the pharma space, roughly similar size. Now, over the last 12 months, Pfizer the worst performing, so you can argue it isn't really around the sector. The issue lies with Pfizer. It is isolated. They are the only one down, and that includes reinvesting those dividends. Over the last 5 years, again, down 13%, the only company. Over the last 10 years, if you were reinvesting your dividends every quarter, you would be up only 28%. But as we can see, the industry as a whole, unless you invested in Zoetis, has been fairly terrible, underperforming the S&P. Remember though, past performance doesn't define the future. They could perform a lot better. In fact, they could also perform a lot worse. Then we move on to the comparison against the S&P. Now the results will be very obvious. Over the last year, over the last 5 years, and the last 10 years, S&P has massively outperformed. Now we do always appreciate investors will be considering companies for different reasons. Some will be looking at Pfizer just to use that 7% yield in their expenses. Others will be looking to outperform. So do also bear in mind and consider a low-cost ETF like VO that just tracks the S&P 500. Now let's jump into the valuation model. As always, if you do enjoy the content, value is being provided. Smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now, how we got to our intrinsic value today at $37, we ran it through 4 models. First one, Graham's valuation, EPS, long-term growth rate, AAA corporate bond, giving us our first intrinsic value, massive undervaluation. But remember, we don't look at any one of these models in isolation. We'd have the multiples valuation, companies in a similar sector and size, the average PE multiplied by the EPS of Pfizer to give us another massive undervaluation. We then move on to the dividend discount model where we have the increases over the longer term, around 3.14, a little bit more conservative at around 3, again another undervaluation signal. Then we have the DCF model, free cash flow year on year, average growth 3.4. We've gone for 7 around management targets, a little bit more conservative. With the discount rate at 8%, get the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by shares outstanding, and as we can see, 4 for 4, all signs of undervaluation, $37, just the average of these models. And as always, you can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for Pfizer or any others. Now, current price around $24.80. We always like to do an MOS at 10%. Execute on that if it meets our 3 golden criteria: wide moat, strong financial metrics, good forward-looking data. If you believe that in today's episode, a buy at around $33.40, then we keep going till it's near the current trading price. And what we can see in today's episode for Pfizer, which does trade essentially near a 7% starting yield, you are getting between a 30 to 35% margin of safety. Whether or not that is enough based on the fear of RFK's appointment for the health minister, something to consider. But we can see Wall Street, they did give it that buy rating, in fact near a strong buy, $33 over the next year. They see upside of 33%. So in conclusion for Pfizer, between a 30-35% MOS, 33% upside over the next year projected by Wall Street with a 6.77% starting yield. Let us know your thoughts, whether it's a buy, hold or sell. And as always, if you did enjoy the episode, value was provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Don't forget to sign up to the free weekly newsletter below and come and join us in the Patreon where we do talk about our weekly buys and sells. As always, have a great day and we'll see you all on the next one.